Hello everybody, it's Chris Darbyshire and Tom Sheridan from 7IM. We're here to talk about what's going to happen in the 7IM portfolios from an asset allocation perspective over the next 3 months. Now what we'd like to do is to take a good look at what happened in the first quarter, to then address some of the key themes going forward in the second quarter, and to culminate with what we're doing about that in portfolio positioning for you and for your clients. Now, Chris, let's start with quarter one. The most volatile opening to a year probably that I've seen in my entire career, which is about 40 years long at this point in time. We had equity markets off anywhere between 10 and almost 20% in 6 weeks. Unparalleled volatility, followed by a rebound. Now, if you'd have listened to the papers, you might have thought that US interest rates were a culprit. You might have thought that Chinese currency was a culprit. You might have thought it was the hard landing in China. You might have thought, no, it was deflation. No, we're going into recession. The newspapers probably have a lot to do with the volatility that we had seen. However, what really was going on?
I think markets themselves were the problem in Q1. I don't think they were following the macroeconomic data very closely. I think they had gotten into a state of panic for reasons that we don't really know why. Markets have a structure all of their own, and that structure is changing in the modern world with lots of digital technology behind trading, and the banks that used to be making markets now really pulling out of that function. So markets are very different.
So different market structures, we're looking at the underlying economic fundamentals, not really seeing panic in the economies, but yet seeing it in markets.
I think what we saw in the economic data was just a continuation of the theme that we've had since the credit crunch, which is that it's been a slow and painful recovery.
And indeed, there has been a bit of recovery in markets. So since the first 6 weeks, we're almost back where we were when we started the year, with the exceptions of Japan and Europe.
Yes, so Japan and Europe still down, mainly because their currencies have rebounded from the weakness that drove those markets last year.
Okay, so let's take a look at Q2, what we expect to happen in Q2, and then subsequently what it is that we're going to do about that in the portfolios. A couple of key themes for us. Let's try inflation for the first one. Are we inflating or are we deflating?
So if you look at the headline inflation numbers, you would think we're deflating. But of course, these numbers are very distorted by low oil prices. Once you strip them out and look at what we call core inflation, it's a very different picture. And you see an acceleration in core inflation across most of the major economies.
So oil, as you mentioned, a really key factor in the inflation-deflation expectations. It dropped from 115 to 30 within 18 months, another unprecedented bout of volatility. What impact is that going to have on the world? Is it going to be a net negative or is it going to be a net positive?
Certainly a net positive, but it may take time for that to become apparent. Markets, I think, have only been looking at the negatives. And there's been a narrative of oil price down, that means deflation, that means the economy must be slow, demand must be slow. Actually, we think the thinking is the other way around. Oil price is down because oil companies are very good at producing oil. It's a supply problem, not a demand problem.
Yeah. If there is such a thing as good deflation, this might be it, huh?
There are many types of good deflation. Well, we would have welcomed some deflation 20 years ago. Most of the deflation we're seeing at the moment we think is probably good for the consumer in the medium term.
Okay, so when it comes to oil and deflation, we think we have a good idea what we're looking at. There's a couple of things that we're not as positive at the moment. Brexit has to be top of the list. What do we do? What's going on?
Yes, so Brexit's a complicated one and will, I think, involve real risks between now and June. News articles, surveys, polls will get blown up out of all proportion and will move the market, and that will primarily, we think, impact sterling, may have an impact on UK assets such as gilts, for example, but the majority of the impact is going to be on sterling.
Okay, so in order to protect ourselves against the risk of Brexit, we may have to reposition some of the portfolios from a currency perspective as opposed to assets such as equities and fixed income. Huh?
Yes, I think avoiding sterling becomes a very key risk management device over the next few months.
Okay.
One, of course, then has to be careful in case Brexit is not what happens. You then need to be back into sterling for a snapback.
So a bit of a debt management looks like it's going to be required on the near-term horizon.
Yes.
One of the other themes for the second quarter, which has carried through since the end of last year, really is China. And what is the impact of what we're seeing in China? What was it, real problems? Was it a communication problem that the Chinese were having? And what are we looking for going forward?
We've not seen a worsening of the problems that there are in China over the last 18 months. If anything, the government has been very active in admitting problems and addressing them. I think what we see is markets beginning more and more to focus on China and to blame China for problems around the world. So it is a problem. However, the hard landing has not materialised in China. The currency devaluation is still a pretty trifling affair. And of course, the really big change we've seen since the start of the year is the dollar beginning to weaken. This means that other currencies, such as the Chinese currency, the euro and the yen, begin to strengthen. And I think that alleviates a lot of market worries.
So if we take the inflationary picture, which looks like a bit more inflation than you maybe thought in the US, if you take the Chinese picture, if you take the fact that markets have rebounded, equity markets in particular, almost all the way back, what is it that we're going to do to protect customers' capital and to grow the capital over the medium to longer term for the next quarter?
So we've made several main changes to the portfolio this quarter. We're going to maintain a reasonably high level of equities in the portfolio. However, we're going to change the mix slightly away from economies whose currencies are strengthening. So it's away from Japan, which goes back to our strategic neutral position, away a little bit from Europe, which stays overweight but less so, and moving more to, for example, the UK, where the FTSE 100 should benefit to some extent from weak sterling and also from the rebound in the oil price and those sectors, the commodity sectors, the energy sector that have been very weak recently, showing signs of strength.
So our customers are going to have exposure to the US dollar, a fair bit of the euro, and some of the emerging market currencies. Is that right?
Yes, we'll dial up the exposure to foreign currencies this quarter, mindful that we may need to dial it back down if Brexit is not the case.
Okay, so from a Brexit perspective, we have portfolio insurance planned for your customers. The other issue that we wanted to get our minds around was inflation. How is the prospect of inflation, when it doesn't appear to be on the horizon right now, going to play out in the 7IM portfolios?
Yes, it's a bit more of a worrying one, this, because the world is so obsessed with deflation at the moment that we're worried that any kind of inflationary surprise could meet with quite a serious reaction in markets, which would be felt most keenly in bond markets. We've been concerned about bond markets for a long time. Now I think we're really getting quite worried. So we want to move the portfolio really into inflation-protected assets, such as US TIPS. There's a US equivalent of linkers. We'd like to get as much.
So linkers and TIPS, that's inflation protected bonds?
Inflation protected, yeah. And the US looks to be the place where inflation is most mispriced at the moment. So we think there's good upside there. And of course, TIPS give us US dollar exposure at the same time.
Right. Gold, did I hear you say?
We've decided to take a position in gold, 3% in our balanced portfolio.
He hasn't done this for years, by the way.
Yeah, we're not big fans of gold from an investment point of view, but we think it fulfills two functions at the moment. First of all, it's a currency in its own right, and if sterling is under pressure, then gold might work quite well. Indeed, if the US dollar is weakening, gold might do quite well. Secondly, of course, we do have a real risk out there, which is Brexit. And we think Brexit could be quite destabilising for the UK economy and for UK investors. And I think one good way to address that tail risk issue is gold as well.
Okay. Well done, Chris. So to wrap up, what you're looking at for the coming quarter with 7IM is a bit equity risk off the table, a bit more currency risk on the table, particularly with Brexit in mind, some inflation protection, and very, very mindful that these things can change again very quickly, so ready to move as and when necessary. And those are the kind of things that we're doing to help preserve your capital and to help you get those returns over the medium to longer run. Thank you very much for joining us today, and we look forward to seeing you again in 3 months' time.